Now, since the introduction of the Nigerian Pension Reforms Act in 2004, how has the financial system been improved by some of these reforms, if at all?
Well, before 2004, there were no serious institutional investors in Nigeria. You had insurance companies and you have the asset management companies. And by way of, just to give you an indication of size, the institutional investors, then the insurance company, the largest one had about $150 million, in asset portfolio, and the largest institutional investor, the mutual funds, had less than $200 million. Now, the pension fund has sort of, organized a compulsory, which is like a compulsory savings scheme, has sort of created a pool of investable funds, which is now able to support the financial markets. If you look at the bond market, before now, the longest paper in Nigeria up until 2003 were 90-day papers, the treasury bills. Now, that coincided with the pioneering effort of the former finance minister to create the long-term bond market. Now we have 20-year bond market, 20-year papers in the market. We had 7 years and we have 10 years papers. We also have corporates and subnational bonds being issued, and pension funds are the largest investors in these asset classes. You also look at the equity market. The pension funds, I would say, constitute a consistent buying power in the market.
Right.
And when the foreign portfolio managers exited the market 2 years ago, the pension funds held their portfolios, right, particularly in some of the very good stocks. So whilst a lot of people were leaving the market, the pension funds saw the opportunity to buy at what are bargain prices, and therefore provided stability to the financial market in that respect.
All right. Now, Dave, as of Q1 of year 2010, pension fund accumulation in Nigeria is said to be standing at about 1.6 trillion naira. So it's definitely a vibrant and growing sector. 38 pension fund administrators available on the market and 4 million contributors. Now, with such extensive exposure on the Nigerian capital markets, just by way of investing in bonds and shares and bank deposits, as you've been telling us, what's the system of protecting them from some of the issues that have emerged in the banking crisis in Nigeria, and what's the regulatory framework like?
Well, there are 26 pension funds in Nigeria, and there are 7 closed pension funds. In other words, the pension funds run by corporations. Now, by way of regulation, the pension funds can only invest a certain percentage of the assets in certain asset classes. I mean, specifically, the pension funds can't invest more than 25% in equities, which meant that even when the market went down, the pension funds in 2008 lost only about 1%, whereas the market went down by close to 37%. Now, a lot of the pension assets are invested in government securities, bonds, sovereign bonds, subnational bonds, and corporate bonds. So by way of asset allocation, we can only invest up to 35% in banks. Now, we can only invest in credit-worthy banks, in other words, banks that have ratings of A+ and above. And when the banking crisis did happen, one of the good things that the central bank did was to guarantee all pension fund investment in banks and interbank placements. So in a sense, the pension funds, pension assets were shielded from the turbulence in the market. By way of regulation, the regulator is very strict. I would say is one of the highly regulated and best regulated industries in Nigeria today. The regulator is very strict. We submit returns on a daily basis, where the regulator sees whatever we do at the end of every day. So, in a sense, the pension assets have been shielded from the turbulence. But obviously, I mean, as participants in the financial markets, you cannot completely shield pension funds. So we, it depends on the skills of the investment manager in each scheme.
Now, in terms of the role of the pension funds, in terms of the broader economic development of Nigeria, how are they structured, or how do they view themselves? Because you have in South Africa, for instance, there have been calls by the Minister of Economic Development to take a proportion of the earnings of pension funds and direct them into government bonds so that we can try to fill the financing gap for infrastructure in the country. It's still a discussion point, but it's one of the proposals on the table because they're seen to have an obligation to the broader developmental process. In countries like Chile, the savings pool from pension funds have limited the propensity of Chileans to rely on short-term capital flows into the economy because there's a wide enough pool for public investment from there. Is that the kind of role that pension funds play in Nigeria?
Yes, I mean, it's similar role, though it's at an embryonic stage because you have to understand that infrastructure as an asset class in Nigeria has not been properly structured. Now, the discussion going around now between the regulator, SEC, the pension fund administrators, and the Infrastructure Commission is how to direct pension funds into this asset class. In other words, how do we create either infrastructure bonds or infrastructure funds that will then use some of these pension funds to invest in infrastructure? But what is happening now today is that pension funds do invest in government securities, and then government has the liberty to use the monies to either finance a deficit in the budget or to put it in direct infrastructure spend. So in a sense, pension fund is seen as a pool of national assets that could prevent the country from undue dependence on foreign capital. And by way of just a comparison, the proposed sovereign wealth fund for Nigeria, even if it takes off, I don't think that it will have as much assets as the pension funds in Nigeria. So I think that where we are today is a discussion going around as to how to use the pension funds to provide or finance the housing deficit through mortgage bonds, right, and how to directly, channel it into infrastructure financing.
All right, Dave, our guest host, Kwebi Lekranji, would like to ask you a question. Kwebi?
Hi, Dave. Maybe you can maybe just answer this question briefly. If the majority of the assets are invested in bonds, I get the feeling that you don't allow for a huge amount of stock to be held in these pension funds. How do you then allow for a growth element in these? Because obviously you need stock to grow.
Well, I mean, 25% of the funds can be invested in stocks or equities. Well, when we started, because the thinking then was that since the new industry, it's better to invest it in asset classes that are not, subject to unduly wide fluctuations in the market. Now I'll accept that it's a bit of time now to relax some of those investment guidelines and to increase allocation to real asset classes like stocks or pension index bonds or private equities or infrastructure. But what has happened, I mean, coincidentally, because of the regulation of the asset allocation, it prevented the pension funds from, the undue turbulence that happened over the last 3 years as a result of the global financial crisis. Now the regulator is looking at it, and I'm quite hopeful that over the next 6 months, some of those laws will be reviewed to allow us to invest in real asset classes that would then, lead to growth in overall assets.
Dave, just another question. Do you, in Nigerian pension funds, just for other viewers of the show, do you allow the holding of international equities, or is it predominantly only Nigerian equities that are held?
Well, at the moment, only Nigerian equities. Again, one of the areas the regulator and the regulator and the pension fund as a whole, and some of us serve on those committees, we're looking at is how can we incorporate foreign securities, and we're really looking at foreign securities to serve as some sort of hedge against the valuation of the local currency. So I suspect that if that law is reviewed, we'll be more looking at investing in bonds issued by maybe sovereign bonds of emerging markets and, rather than foreign equities. However, I suspect that we might be able to buy into foreign equities using funds and other sort of ETF or index products.
And then, Dave, a final question from me, just in terms of your medium-term outlook for Nigerian pensions. We know that the stock market in Nigeria hasn't been performing particularly well in previous sessions, and over the last few months, we've just seen a modest recovery in the last few days. We know that inflation is above 11%, and for anybody wanting to invest in government securities, that's going to be an issue that affects them. And anybody wanting to come into the Nigerian pension environment, given the poor performance of the capital markets, there might be a disincentive. What's the mitigating factor that could kind of make it a little bit more attractive as opposed to just a necessity to put away money for retirement?
Well, that's a very difficult one. You're right. At the moment, inflation is running at close to 12%, whilst the model of any pension fund based on asset allocation could yield you between 10 and maximum 11%. However, we have seen issuance by subnationals and corporates bond with coupon of 13.5, 12%. So we also looking at more issuance from the corporates because currently the corporates are able to borrow monies from banks at 15-16%, but while they issue bonds or even commercial papers of 360 days, 1 year duration, they could get 12 or 13%. So we believe that the introduction of such papers will enhance the yield of the portfolio. And I think that, you know, what is happening in the equities market. In 2007, for instance, the pension funds returned about 25%. So in a sense, what is happening in the equities market, I don't think it's something that will last for a very long time. I suspect that by next year, or even this year, as we speak to year to date, most pension funds are up about 12% year to date. Right. So except the market goes, and I suspect that will be above inflation at the end of this year.